And welcome to the Investor Coaching Show. Paul Winkler, talking about the world of money and investing. And covering some things. A couple things I want to hit from last week a little bit. I spent a little time on this, and I thought I needed to spend a little bit more time on this particular topic. I had a couple of meetings from the week, and several of them were, people owned annuities, and one where they actually is a variable annuity. I don't talk about variable annuities a whole lot, but I just want to cover this particular topic just because, this is something that you see from time to time. Now, difference between annuities. You got fixed annuities. That's where you just have a fixed interest rate. The insurance company's portfolio is what is responsible for giving you the return of the annuity, and typically insurance companies are very heavily weighted in bonds. More about that in a second. Then you'll have indexed annuities, and there are some new ones coming out there. And I think that insurance companies are going, a lot of people are on to us. There's some of these products that are out there we don't want. So they're coming up with even more sophisticated products, so much so that they're so complicated that, you think that the stuff that's out there now is complicated and hard to understand. Just wait till you see what insurance companies come out with next. I think it's going to be so complicated that, I think a lot of the salespeople don't understand the products right now, but it'll be even worse in the future where they just really don't understand what on earth they're selling. But it's typically what happens. Insurance companies will come out with a product, and it'll be something that, maybe solves a complaint that people have, or an objection that they have about previous products that were put out. For example, maybe people don't like a participation rate which is lower than 100%. And in other words, if you have the rate of return of the S&P 500 is 10%, but your participation rate is only 5%, you only get 5% or 50%. Your rate of return is only 5%. You only participate in half of the gain of the S&P 500. If it's 10, you get 5%, 50% of the rate of return. Well, so what happened is people really complain about that. I was like, that's terrible. How am I ever going to make any money on this product? So they go, here's what we'll do. We'll give you 100% participation. 100% participation. And we'll cap it at 3% per month, would be what they would do. And you think, 3% per month times 12 months, that's 36%. Hey, that'll work. Okay, I like that. And people don't think about the fact that you could have a 10% return in the S&P 500 in one day. And, if you have, let's say, a month that it's up 10%, then you get 3% of that. Well, you're 100%. You get 100% of that 3%, but it's just 3% and the rate of return. So it'd be like having a 30% participation rate. So they solved the problem. No, they didn't solve the problem. They just moved the problem to something else. And that's what insurance companies are really good at, is coming up with something else. And another thing that you see a lot of, and I saw, in this particular week, it was an income rider, and somebody had this investment portfolio in an annuity. It was a variable annuity, so it had mutual funds in it. And, mutual funds can be in all different types of flavors. You can have some investing in large companies, some in small companies, large value, small value. And in this particular case, this person had a growth fund in there. They had a Dow fund in there. They had a healthcare fund in there. They had, there were a lot of different funds, but they were all investing in the same area of the market, which is large U.S. growth companies. And as recently, that's the area that's kind of started to falter. But before that, it's been okay. But in effect, what happens is when that area falters, and it can falter for long, long periods of time, you could go without any returns whatsoever. And what insurance company knows is that, you're probably averse to risk, or maybe don't like the idea of the possibility of losing a bunch of your money, because maybe you did. Maybe you, during the tech bubble, when that unwound from 2000 through 2002, you had large growth stocks go down over 40%. And then you had tech companies going down 80%. So imagine your $1 million portfolio is being ground down to $200,000. I mean, that's a pretty bad day, or a pretty bad few years anyway, right? Or what about, 2008, the decline that happened in that particular year? Or what about, literally the entire decade from 2000 to 2010, where you had a negative return in that market segment? What about, the 60s through the 70s and into the early 80s, where there was no return after inflation? So people are sensitive to 1987, a big, downturn that happened that year, 1990. So you look at these downturns and you go, well, I know that they can happen, and I'm scared of it happening because as I get older, I don't want to work longer, and I don't have time to work longer, and maybe I won't be able to work because maybe I'll get laid off, or whatever can happen that causes you to actually have to retire, or maybe your health starts to fail or whatever. So people are very sensitive to that. So what they do is they'll come out with a product that says, well, it's going to fluctuate with the market over here. You'll have one account over here that'll fluctuate up and down with the market. And you'll have this other one that'll just go up, and you basically have this income type of an account over here. Guarantee it'll only go up. You can't lose money. And by the way, what we'll do when you get to retirement age is, if this goes to heck in a handbasket, this account that fluctuates with the market goes to heck in a handbasket and crashes and goes down in value, you'll have this to fall back on. And we'll base your income off of this account over here that can't go down. Well, how can they do that? Well, they can do that by basically saying to you, okay, we're going to give you an income that is going to be, and it'll be set based on your age. So if you're 65 years old, it'll be this percent. If you're, 67 years old, it'll be this amount. If you're 70 years old, it'll be this amount, this percentage. And the insurance company sets that percentage. So what they do is they set how much it grows, and then they set the percentage that you can pull out. And they set it at a rate where they feel comfortable that with whatever safeguards that they have, that they can't mess up that badly with the investments. Is really what it is, that they can't pay that amount of money somehow, some way. So it's a fictitious account that goes up all the time, giving people a false sense of security. Now, that is an income type of a rider, and they charge a fee for that. And the fee that they charge for that is so high in order to put money back in their reserves, so they can actually make good on that promise to you. So that's how they do it. Well, so in that particular case, I usually will explain to somebody, hey, look, this is how this account really works, and here's what's really going on, and that's a fictitious amount of money. And the example I'd given in a video years ago to really make this, to come to life to people, I sat through a workshop where you had a 5% guarantee and you had a 7% guarantee. And the salesman was showing, well, if you put your $100,000 in these, we got these two products that we sell. And, I've been looking at the market for you, and I found these two products, and one has a 5% guarantee. It goes up 5% no matter what happens in the market. This one has a 7% guarantee. And, the one that pays a 7% guarantee, it'll kick out an income of $5,000 later on. Let's just use as a number. Well, the one that has a 5% guarantee actually kicks out an income of $6,000. So, you, Mr. Client, Miss Client, I would probably be inclined to have chosen the 7% guarantee product. But, here's the service I'm bringing to you. Me, the financial advisor, I am just so wanting to help you and be of service to you that I've actually looked at how the product pays out income, and I've found that the one that has a 5% guarantee, that actually pays you out $6,000 or more than the one that has a 7% guarantee, which only pays $5,000. So, this is really, this is why I recommend that you do this other product. Now, meanwhile, they don't tell you that there's another product out there that'll pay you $7,000 and will only drop down the $6,000. This is the example I gave in the video that I taught on this. It'll only drop down to $6,000, which was the better of the two products, if you lose like 20% of your money. So in other words, you'd have to lose money to get that little with this other product over here that doesn't have that rider and doesn't have those quote unquote guarantees. And this is what you got to watch out for, is the fake guarantees and the fake accounts in these products. And, the insurance agents, a lot of times they're not even aware of this because, they really don't analyze many times these things. I say many times, I'm just going to tell you my experience. And, a lot of people that I've worked with over the years, great people, love them as people, but they didn't typically tend to analyze things very deeply, and they would be just regurgitating whatever the manager told them to say. Ira, who works with us, loves to tell the story about how he would sit there and he would analyze things, and the manager would just say, Ira, just quit and get out there and sell something. And he'd be like, no, I want to understand this. No, just get out there and sell something. So one of the things that we have been looking at is, interest rate issues with insurance companies. So the interest rates, part of what causes an insurance company to be able to pay out promised benefits to you are the interest rates that they're earning on your money. And this is the problem that we've been seeing lately, is that the interest rate, and that was this article right here in Financial Advisor magazine, was talking about the interest rate question for annuities and what is going to be happening there. But I want to spend a little bit more time on this one about lower interest rates for longer and what does Fed policy mean for the life insurance industry. And this is really important because something that's been happening with insurance companies and something that they pointed out in this article I thought was really good. It says they had a chart, and those of you watching the video version of this, you can see this chart right here. This is so I'm actually video recording the podcast right now as I speak. It talks about the impact of falling rates on insurance companies. Now it says, here's what happens. If interest rates go down, then premiums go up because an insurance company has to charge higher premiums for whatever guarantees that they're giving you in their products due to the lower discounting. So, all of these benefits are based on discount rates. And if you've ever messed around with calculators, financial future value calculators, you'll know that you'll see that a different present value based on whatever the interest rate is. So if we have lower interest rate, you got to charge higher premiums in order to pay the benefits that you're promising in the future. But what happens when you have interest rate declines, the next step in the process is your demand for insurance goes down. Because people look at it and go, I don't know if I necessarily want this. It's a lousy rate of return. So now you're selling less of your product, which is a problem, because how do you make money selling your product? And then the insurer's revenue goes down is the next step. And then the other thing that happens is if you have interest rates go down, your fixed income returns go down. And the insurer's profits go down. And you have to increase your capital reserves. So in other words, you have to put more money aside for meeting any obligations you have in the future. This can be a real problem. And that leads to insurers' solvency going down, is basically what they point out here. Well, what is it that has been the biggest sales point of insurance companies for a decade now? We're going to guarantee your investments. You can't ever lose money with us. You have safety with us. Don't worry about market fluctuations. We'll protect you from these things. And that is the very thing that is actually being, we're running into problems with these insurance companies, is the solvency could become an issue in the future. So what are insurance companies doing? Well, a couple of things. One of the things that they're doing is that they are buying longer term bonds. And if they buy longer term bonds, as I pointed out last week, if interest rates go up, they're stuck with those long-term bonds that pay low interest rates. They got a problem. And then when they're going out there and marketing their future products, nobody will want them anymore because the interest rates on their portfolio are the low old interest rates. You see the problem? You can't even sell your new products if you go out too long. But if you go too short, then what happens is you're getting lower interest rates on your investments because typically you have a positively sloped yield curve. In other words, interest rates for short-term bonds are lower than what interest rates are for long-term bonds. So what you can promise people is even less, and nobody wants your stuff now. So what's another thing that insurance companies are doing? Well, another thing that they're doing, according to this article, is they're actually loading up on lower quality bonds. Said research from Fitch Ratings indicates that the credit profile of insurers' assets books has deteriorated in recent years, they said. Traditionally, insurers held mostly A-rated bonds. That's typically what insurance companies do. They have highly rated bonds. Before the financial crisis, such instruments comprised almost 70% of insurers' portfolios. However, by the end of 2018, that proportion had fallen to around 61%, and the share of BBB-rated bonds rose to 34% from 25%. And BBB-rated bonds, as they point out in this article, are just one notch above junk. So shifting composition of insurers' corporate bond portfolios indicates an uptick in portfolio credit risk. And this is the issue. This is why I like to point this stuff out, because a lot of times in the sales presentation, you don't necessarily get this side of the story. That, when somebody's coming in and saying, we're going to give you, we're going to protect you from downside risk. You're getting a retirement. You need to protect yourself. You're going to be around for a while. You can't run out of money before you run out of life. And the sales pitch sounds really good, but they don't necessarily talk about what's going on in the insurance industry and what can go wrong. What they'll say, and some people, you're not supposed to do this, but they'll say, there's a state guarantee fund. Why are they not supposed to do this? Because it's unfunded. In other words, it's not like the FDIC. It's not like, you have homeowners insurance and you're paying premiums in case somebody else's home burns down or your home burns down, and we pool everybody's money to pay the claims. No, this is an unfunded guarantee account. And here's the problem. Unfunded means that there isn't money there. A. B. Here's the other problem. This is a global problem. It's not just happening to one insurance company. You might have a guarantee fund that says, okay, if we have 5 insurance companies in the state and one runs into financial trouble, the other 4 will come to that company's rescue or the rescue of their clients. No, we have a problem that affects all 5 companies. And that is an issue. There's nowhere to hide when that happens. So realize there is no such thing as return without risk, as I often say. Paul Winkler, Investor Coaching Show, right here on Super Talk 99.7 WTN.